Extended pullback or sweep pullback occurs when the price moves deeply and for an extended period against the main trend before eventually resuming the trend. Unlike sharper or quicker pullbacks, an extended pullback retraces a significant portion of the prior move, sometimes approaching previous key levels or zones of support and resistance where liquidity tends to cluster. The depth of the pullback is substantial, often moving far into the trend, sometimes retracing over half or more of the prior move. It can take longer to complete, spanning several sessions or periods, which can make it appear as though the trend is losing momentum or even reversing. Extended pullbacks often reach areas of high liquidity, such as previous swing highs and lows, demand and supply zones, or other critical support and resistance levels. In essence, an extended pullback is like the trend taking a long pause or a deep breath, collecting liquidity along the way before continuing, offering traders a larger window to enter the market with favorable risk to reward conditions. In an extended pullback, the liquidity zone is often around the last higher low, but because extended pullbacks are deep, price can dip through the nominal demand zone before finding enough buying interest to reverse. This is normal and doesn't automatically mean the trend is broken. Here's why. The demand zone itself marks where buyers are likely interested, but extended pullbacks reach for additional liquidity below the previous higher low, triggering stop losses from weak positions. In an extended pullback, price may temporarily move through or slightly beyond the normal demand zone or previous higher low, which can make it look like a reversal is forming, but it doesn't always mean the main trend is broken. Here's the nuance. Extended pullbacks are deep retracements, so price can sweep through the normal zone to capture liquidity, triggering stop losses from weaker positions. After this liquidity sweep, if the trend is still intact, price usually finds support at the liquidity zone and resumes the original trend. A true reversal would require breaks of key structural points. So, even if price almost seems to reverse during an extended pullback, it's often just a trend pause and liquidity grab, not a full trend reversal. Smart money often allows price to sweep the demand zone slightly, grabbing liquidity before pushing the trend back in its original direction. That's why in an extended pullback, it's important to treat the zone as a range, not a single line. Entering slightly above, within, or just below the nominal demand zone is acceptable if confirmation appears. Start by identifying the main trend on a higher time frame, such as 4-hour or daily. Next, locate key liquidity areas where the extended pullback may pause or reverse. These include major demand or supply zones, previous swing highs and lows, and areas slightly beyond the last higher low in an uptrend or lower high in a downtrend. Extended pullbacks often reach these zones to capture liquidity before resuming the trend. Switch to a lower time frame, such as 15-minute or 1-hour charts, to refine your entry. After identifying the liquidity zone where the extended pullback is likely to end, switch to a lower time frame. Observe the short-term swings. The pullback will usually form a series of counter-trend highs and lows. Wait for the change of character, price breaking the minor structure in the direction of the main trend. This break acts as confirmation that the pullback is over and the trend continuation is likely. As soon as price breaks the minor counter-trend structure high in an uptrend, you may execute an immediate breakout entry. Positioning your stop loss below the liquidity sweep or the most recent minor low in an uptrend provides an early entry supported by strong directional momentum. Another valid entry signal occurs after a change of character. Once the structural shift is confirmed, price frequently retraces to retest the origin of the break. This retest zone transforms into a newly established demand zone in an uptrend, a newly established supply zone in a downtrend. Your entry is then placed at the retest of this refined, freshly formed institutional zone. This approach is particularly effective during extended pullbacks, as price often revisits the swept area before continuing in the dominant direction. Your stop loss should be positioned beneath the change of character generated demand zone in an uptrend. This refined confirmation provides a tighter stop loss and a more precise, higher quality setup. You only execute the trade after clear confirmation and evidence of newly injected institutional order flow, ensuring alignment with the true underlying direction of the market. All right, that's a wrap for today. No matter the type of pullback, always keep an eye on the overall trend. Make sure the pullback hasn't broken any major structure, and watch how price reacts around key demand and supply zones. Avoid chasing the market, entering without proper confirmation, or assuming that every pullback will hold, especially when momentum is strong against the trend or there's no sign of slowing down. Not all pullbacks are safe to trade. Some are fake pullbacks that signal a trend reversal. Using confirmations like break of structure or price action signals helps avoid them. Stay patient, wait for the structure to align, and let the market clearly show its intention before taking any action. All right, traders, that brings us to the end of today's video. If you found value in this breakdown, don't forget to subscribe and turn on the notification bell so you stay updated whenever a new video drops. Feel free to share your thoughts in the comments. Let me know what you enjoyed, what you didn't fully understand, or any topics you'd like us to cover next. Your feedback helps us improve and create better content for you. Thanks so much for watching, and I'll see you in the next one. Take care.